Hi, I'm Jerry Bowyer. This is the Eagle Investing Network. Thanks for watching. Make sure to hit subscribe. Well, this is the last in our series about the Congressional Budget Office, the bipartisan Congressional Budget Office. So it's made up of Republicans and Democrats, but it's made up of people who work for the government. So it might be the biggest difference in America right now isn't between Republicans and Democrats, but between the government, the ruling class, and the rest of us. So we have to take all of this with a grain of salt. So when they acknowledge a problem and they're in charge, well, when the people in charge acknowledge problems, I think we need to take that very, very seriously. So they're acknowledging a problem. What is it? Well, it is slow economic growth in the United States of America. So this is economic growth, 0 to 4%, 3.2, 3.5. All right, so this is the post-war boom. This is at least part of the stagflation period. This is 82 to 90, just understanding that there was a terrible recession in 82. So after that, things really began to boom. So this would look better if we started, like if this was 83, this would look like a really good chart. The moderation, they called it the Great Moderation of the 1990s, also pretty good. The aughts, this is the Bush economy, 2.4% on average. Then, of course, we have 2008 forward. This includes the Great Recession. So that wasn't very good. So that's basically past 13 years or 12. I mean, I'm doing this in 2022, so it doesn't include this year. And that's what happened in the past. And here's the projected. So this has two serious recessions in it. The Great Recession and the COVID lockdown, kind of a self-imposed recession. This is what's expected from 2022 to 2026, the next few years. And this is what's expected over the long term. So you see, it's a lot lower than historic average. Servicemen came back, had babies, went to work. Well, now they're retiring. And that's showing up here. Potential labor force productivity. This is how much more productive we can get. You know, when you're in the workforce, you get smarter, you get better at your job. That's why you get promotions. Technology makes us better as well, makes us more productive. So this is saying that over the next 4 years, we can get each person on average can get 1.6% better at their job. Or they can get 1.4% better at their job over a longer time period. This is saying, however, we're not going to have as many people. We don't have the potential labor force. We can't have as many people getting into the labor market. Now, this has been artificially low, so it can still increase because a lot of people were laid off during COVID. So we have a little growth here, but you can see that what's the problem? Why is this low? It's not low because the orange, the increased productivity per person, is growing slowly. It's low because the number of people is growing slowly. And this could actually turn out to be negative depending on, how many people actually get out of the labor force. So we're up against a demographic headwind. So let's say we cut taxes like crazy and there's incentives to be more productive. Maybe this goes up to 1.7, maybe this even goes up to 2%, but we're limited by the number of people, because incentives only matter when there's people to be incentivized. So we've got a problem here, and the problem is we've gone from this to this demographically. So even if we're getting more productive and you're learning new software and you're learning new equipment and you're getting better at your job and you're learning new procedures and learning ways, more hacks and more ways to be productive, that's great. That's assumed to be about normal. That might be a little optimistic given the fact that our policy environment really right now isn't incentivizing a lot of productivity increase. So these oranges might be a little optimistic, but so let's assume that our growth and productivity per person will remain normal. Very open question. As we're getting older, we might slow down a little bit. That's happening with me. I'm 60 and, it's a little hard for me to produce as much as I used to. And I expect that might happen more and more as I get to be 63, 64, 65, and fewer people. So the potential labor force is our headwind. So there's some things we can change. We can make tax incentives better. We can make it easier for a business to invest in capital. For example, we can have research and development tax credits, and we can allow companies to write off expenditures on equipment in the first year, rather than saying, well, this equipment lasts 10 years, so you have to spread out your tax deduction over 10 years. That's called depreciation. Even though you pay up front, we can say, no, you can deduct it all in year one. So that incentivizes businesses to go out there and buy new equipment to make us more productive. You can do a lot of those smart things. We're not doing them now. In fact, we're going in the opposite direction, but it only applies to people who exist. And if demographically we're a declining population, there's a real limit to what we can do. It's going to be hard to get America back to the normal growth path. What's easy is getting America into decline and getting decline to be faster. Just keep doing what we're doing policy-wise, and keep up with the early retirement. And for people who are in the labor force age but just don't work because unemployment or welfare are more beneficial, we keep doing that, and we will reach a point of no return. It's easy for a nation to fail, even America. It's hard to succeed. And I think we all need to take account of that as we're investors. So, for example, if you're a growth stock investor, well, there needs to be growth. If we don't have growth, then maybe you change your sector allocations away from the growth-sensitive sectors because they don't have a lot of macroeconomic growth. Maybe you're more back to consumer staples, for example, things people have to buy whether there's growth or not, rather than the big bets on the future. We need to take this into account in terms of the big picture. The markets are a part of the economy. Modern portfolio theory is based on the idea that markets are unrelated to the economy. That's led a lot of people into mistakes. The market and the economy are closely related to one another, and I think we need to be well aware as investors of the risks to the economy. And that's why you watch the Eagle Investing Network, and that's why you're going to subscribe if you haven't already, and that's why you're going to share this with somebody else. Thank you very much for listening.